Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, April 7th, 2020. We are pre-recording this Trading Places Live. Currently, futures are pointing to a very strong open, with Dow Jones futures pointing to a positive open of perhaps 800 points today. But we do know how things can change quickly. We do still have a very significantly high volatility index. And so I wouldn't count anything out either in pre-market or after the market opens. But still, we had a very strong day yesterday, looking to open very strong again today. And that is good news for the bulls. Let's talk a little bit about our upcoming agenda and things we're going to talk about in this particular show. We're going to get into that daily market recap, take a look at those strong numbers from yesterday. Then we'll get into talking technically. I want to take a look a little bit at the S&P 500, bring up those Fibonacci levels, look at the VIX, take a look at what the VIX did back in 2008, talk a little bit about the sector summary, where the money's been flowing over this past week. We've had a big drop, then we had a big rally. Where on a net basis is this money going? I think that's going to be important, and that leads right into a relative strength segment that I'll talk about. And then we'll look at earnings spotlight. Not a whole lot of earnings coming out this week. We're going to pick up on the earnings front beginning next week and especially the week after that. But there are, a couple of companies to continue to watch. And then upgrades, downgrades, just a couple of stocks for you there. And then we'll wrap up the show with the three you must see, three charts I think are worth taking a look at before we get into today's action. All right, let's jump into the daily market recap. And you can see the Dow Jones Industrial Average yesterday up 7.75%, up 1,600 points. S&P 500 also up 7%, 175 points. The NASDAQ up 7.33%. I think you're getting the flavor here. Mid caps up almost 8%, small caps 8.4%, so a little bit of outperformance there. The one thing you see on these charts today that I'm doing a little bit different is I'm just taking a look at the short-term action. So this is just the last 5 days. But I wanted you to see, especially when we get into relative strength and talking technically, I just wanted you to see that the Dow, we closed yesterday almost exactly where we were a week ago. So we had the big move down. We came back. So on a net basis, not much has changed prior to today's strong futures. But we're going to delve into exactly what's taken place over this last week, and maybe it'll shed some light on what we might be able to look forward to in the days and weeks ahead. But we did see strong action across the board there. If we look at the sectors, technology led yesterday. That's a good thing. Technology up 8.5%. Big move. You can see clearing that high from a week ago, similar to the major indices. Discretionary got up to test those highs, but discretionary up 8.3% was in that second spot among the sectors. And then utilities had a strong day. Utilities, though, unable to get back to where we were a week ago. So just a little bit less performance on a relative basis, but the group was up 7.7% nonetheless. Lagging yesterday were staples. So you might say, well, that's not a very good group. But if you look, this group was already equal with where it was a week ago before yesterday. So staples have actually been a really good performing group. It's just that yesterday, I think a lot more money rotated toward areas that have not performed quite as well. And so same held for healthcare. Healthcare has been pretty strong, along with consumer staples. They took a back seat yesterday, not a really big deal. 10-year Treasury yield. By the way, there's not a whole lot of economic reports out until later in the week. This is really a pretty light week overall for economic reports. I think that also is helping the market because we're not seeing those headline numbers that I think we're going to probably see again when Thursday rolls around and we get another initial jobless claims report out. It'll be very interesting after a big bounce to see how the market handles the bad news. Does it continue to power forward, or do we see a top? But we'll get into that in just a minute. 10-year Treasury yield, you can see, closed yesterday at 0.68%. We continue to see a lot of these hollow candles on the 10-year Treasury yield. And if I look at the Treasury prices, this is the iShares 20-year Treasury bond ETF. Many of these are, you can see the filled candles. And this has been one of those themes in the market over the past 6 weeks or so, is that a lot of the fear has hit at the opening bell. That's changed so far this week. Now, I don't know if it's going to continue to change, but yesterday we had the big gap up in equities. Today looks like we're going to have another big up day, at least at the open. And so the fear that was driving the market lower for the last 6 weeks at the open seems to be flipping a little bit right now. And we're getting a lot more of that positiveness, if you will, in the market early on. So we'll see whether or not that continues. But at least today, when I looked, the 10-year Treasury yield, and I'll give you that up to date here. Right now, the 10-year Treasury yield up another 7 basis points this morning to 0.745. So almost 0.75%, which would take us right up into here. This is the area where we held in support for the last 3-4 weeks. Broke down below it. I didn't like it when that happened, and the stock market rolled over as a result. Now we're coming back up to test that area. I think I would say 0.75 up to about 0.80 with the 20-day moving average. I think that's going to be a key area for the 10-year Treasury yield to see if we can get through. If we get through, that's telling us that more and more money is rotating away from treasuries. That could allow the stock market to go higher. But as you look at this chart, this is just the last 3 months, but you can see really only one strong day where we went through the 20-day moving average, and with gusto, here we came back down. We did hold it a second day, but we were down quite a bit in the yield, and then right back below it. So that's why I think this 0.75, 0.80% area is one to watch on the 10-year Treasury yield. If that tops and we begin to roll back over, that means money rotates back into treasuries. That's going to make it more difficult for the S&P 500 to continue pushing higher. Speaking of the S&P 500, let's do a little talking technically here. So we've got the Fibonacci retracement tool here on this chart. And this is what I've been watching since we established a bottom. And that bottom, by the way, came with a volatility index up around 80. I think maybe the high was 83, 85, something like that. Very similar to what we saw back in 2008 when the volatility index spiked to 89 and change. I think our high close may have been around 80, but we were up into the 80s. That is, by all measures, extreme pessimism, extreme fear. And that tends to mark major stock market bottoms. Now, in 2008, when we set that bottom in October and then again in November, we had a double bottom. We did eventually, and I could go ahead and pull this up for you. We did eventually go lower. So here we had October, double bottom, went a little bit lower in November. I want you to look at the VIX. So here was your double top up around 80. We did end up going down one more time. So we sideways consolidated, end up going down one more time. But you can see the volatility index never approached this level. So when you start losing support levels, but the fear is not what it used to be, chances are you're getting close to a bottom or you're at a bottom. That proved to be the case back in 2008. The other thing I would say about 2008 is we were in a secular bear market. And when you're in a secular bear market, you've already got a lot of fear. You've already got downtrends. You've already got a lot of bad economic reports. You've already got people in a very bad mood for an extended period of time, feeling like we're never going to get out of this. I mean, we had an all-time high set in year 2000. Here we are in 2008 with this nasty bear market, 8 years removed from an all-time high. Completely different environment to where we are today. I mean, when we look at the S&P 500 today, literally 6-7 weeks ago, we were at an all-time high, not 8 years ago. Our economic picture, so much better 7 weeks ago than where we were back in September of 2008, right before the big drop. We were already going through a tremendous amount of problems. Remember the subprime issues. Home builders topped back in 2005, 2006. I mean, there was a lot of negativity already built in. Here, that's not really the case. The S&P 500, everything was rolling along, and then all of a sudden, a pandemic hits. Something that, you know, in 2018, even in the early part of 2019, even the early part of 2020, we really couldn't predict. I mean, when the cases started popping up in China, yes, it was a health issue, but there was no way of knowing how bad it was going to be, how easily it would spread, you know, what everybody's efforts would be, how long it would take for social distancing. all of the different issues, the healthcare issues that we have with equipment. Nobody could have predicted all of that. So it's really been a on the fly kind of a market that as the news comes out, and trust me, well, you don't need to trust me, the news has been horrible. So all of these moves to the downside have coincided with huge opening gaps down. But the interesting part is, for the most part, we've seen a lot of rallies during the day. This week, yesterday we had the big gap up and a continuing move. Today we're going to gap up. It looks like probably 3-4%. The latest is about 3% on the S&P 500. That would be roughly about 80 points. So we're talking about maybe 2740 around here for the open. We've got gap resistance we need to watch. We've got this first Fibonacci level at just below 2800. 50% is usually a pretty big resistance level after a panicked sell-off like this. So I would be cautious. If you've been fortunate enough to catch a lot of this move to the upside, I think you got to be a little careful as you get to some of these levels. I am in the camp that believes long-term we're in good shape. We're bullish. It's a secular bull market. Now, when I say good shape, obviously the market, the economy, everything's gone into the tank here in 2020. We're going to have some horrible economic reports out for quite a while. A lot of people are going to lose their jobs. I believe we're going to bounce back. I think the economic recovery will be very, very fast, unlike what we saw coming out of 2008, 2009. And if I'm thankful for one thing about this whole environment here in 2020, it's that this pandemic hit when we were at an all-time high, when our unemployment was at a record low. If we're going to ever be hit by a pandemic, economically, we couldn't have been in a much better position. Imagine this pandemic hitting back in 2008 when the financial system was already on the verge of collapse. I don't even want to think about what could have happened back then. So, there's always a silver lining somewhere. I think that was our silver lining. And so I believe the market's going to bounce back. I really do. I think the market's going to bounce back. I think our economy will bounce back, assuming that we take all the right steps to reduce the spread, keep it somewhat contained, and then put measures into place later this year, because we're probably going to get hit again, but we need to be better prepared for the second wave than we were for the first. I think if we are smart about it, yes, it's going to be a painful period for a lot of folks financially and from a health perspective, but I believe we're going to get out of this on the other side better than most people think. All right, so there is your S&P 500. I would be watching, look for a big reversal. That's the first thing I would look for. The other thing I would look for, and this is kind of important, the VIX yesterday finished almost on its high. We got down as low as 43.45. We closed at 45.24, which was near the high of 45.73, even though the stock market was moving higher into the close and we had this huge day. Volatility right around the mid 40s level. If we go back to 2008, you'll see that the VIX, when we did pull back, when we had these rallies, these two in particular, the VIX went back to the mid 40s from the 80s. We were at the mid 40s yesterday. So if we see the VIX gap down again today, which we should, maybe into the lower 40s, be careful if this VIX comes back up and closes, say, at 45 or above. I think that, along with a reversing candle on the S&P 500, along with maybe the 10-year Treasury yield, getting up into that key area, I think could present a very difficult short-term challenge for the market. I can't see the S&P 500 simply going right back up to 3,400. I think there's going to be too much damage, too many question marks. Is it impossible? No, nothing's impossible. It could happen. I just don't think it'll happen. I think we need at least some additional time to consolidate, to get plans in place for how we're going to deal with this, not just now, but later in the year. So I think there are some real issues that we've got to deal with. All right, let's move on to relative strength. And the first thing I want to do is just show you this sector summary. So this is over the last week. So if you're at your dashboard, the way you get into this is just simply over under member tools, go to sector summary, and then it brings it up for what happened yesterday. Change the period to 1 week. And so now when I go back and I look at that initial slide that I showed you, where we're looking at 1 week ago, see how everything is pretty much where we were a week ago. Well, if we look at this, we can see exactly the movement, the rotation in the market. The big reason why we've been able to break a little bit above where we were last week is that finally we've gotten some relief in energy. So energy, XLE, is up almost 10% over the past week. If you look at the other 10 sectors, it looks like an evenly distributed performance matrix here with consumer staples and healthcare. Remember I said those were actually good performers. Even though yesterday they lagged, they've been pretty good, really good performers over the last week. So don't toss them out because for one day they don't work. I think this is an area, these are two areas I'm going to continue to look at, because if the market rolls back over, I feel pretty strongly these are the two leaders. I think you could actually find winning stocks in here as money rotates away from some of the other areas where we saw strength yesterday. So consumer staples, healthcare at the top. Down at the bottom, real estate and utilities. It's kind of weird because these are four that are considered the more defensive areas. And you've got two of them near the top, two of them near the bottom. And then all of the aggressive areas are kind of right in the middle doing nothing while the overall market does nothing. So I don't know that you can glean a whole lot of information from this. What I would say, though, is that I do think that we still got some obstacles, many obstacles ahead. And with all the volatility that's likely to still be out there, I think concentrating your efforts in some of the more either leaders in some of the aggressive areas, because there are some, or these defensive areas that have shown leadership, I think that's the best place to trade without risking, you know, the house and the boat and everything else to try to trade. Some of these other areas, like if we look at what happened yesterday, and then we go into the industry groups. As you go down the industry groups, home construction, hotels, furnishings, recreational services, consumer discretionary had a big day, but it had a big day because the groups that have been absolutely horrendous saw some value buying. Is it over for these groups? That's, I don't know. You all can make that call. I don't think so, but that's something that maybe everybody's got to, you know, figure out for themselves. I want to stick with areas that I believe are a little less risky in this high volatile environment. You see other areas, you know, aerospace doing really well yesterday. Of course, Boeing's been horrible, but we did get a bounce out of the stock and the group yesterday. And that was, you know, as I looked through, those were kind of the names that I saw leading yesterday, areas that really had struggled. And there's your energy group doing very well there as well. So, you know, continuing this relative strength theme, how am I looking at it? Well, I keep a relative strength industry group chart list. And the beauty of having this is that I can quickly take a look at what is leading over periods of time relative to the S&P 500. And remember, I said that there were some aggressive areas that have been leading. If I look back over the last month, you're going to see broadline retail, trucking, toys. Broadline retail and toys, both part of consumer discretionary. You didn't see them leading yesterday, but they have been leading for the last month. These have been two of the best three groups over the last 3 months. Then you've got your mobile telecommunications, got a industrial area, telecom equipment, software. These are the groups leading over the last month throughout this process that we're going through. These are the groups that I would continue to focus on, along with the pharmas, which are in healthcare. You can start seeing some of these healthcare and consumer staples groups popping up. Pharmas, non-durable goods, food products, food retailers. These are areas that have been outperforming and I would expect will continue. Here's medical equipment. So this is, again, the way I approach the market, I'm going to be looking at some of these types of industry groups for strong performers. So let me just give you an example of this. Let's say broadline retailers is an area that you're interested in. If we go back and pull up scooters, the scooter reports, one way to look at this is to go back into here. This is such a cool feature. I can use this search table of large cap stocks, and I can type in broadline retail. And not only will it give me the three areas. Now, these are all very familiar companies for everyone, Amazon, Target, Macy's. But if you got it set up by scooter, you can see Amazon is clearly the one that's favored by Wall Street. Target is second, and Macy's is one you want to stay away from. So even though broadline retail is looking really strong and has been a great area of the market, Macy's has not. And so Macy's had a great day yesterday. This was kind of what happened yesterday. The strength was coming from stocks that had been very weak for the past, 6 to 8 weeks. Macy's has been in this huge downtrend, had already moved below the March 23rd low. That's a pretty good indication. If you're back testing that March 23rd low, or worse yet, breaking below it, chances are you are not, well, it's not chances are, you are not in favor on Wall Street. And so, yeah, maybe in the short term, we're going to get some of these pops, and maybe eventually some of these are great value plays. I know some of you maybe be looking at some of these companies with a little different approach. And you might be saying, hey, my time frame is not over the next month. My time frame's over the next 10 years. And I love Macy's. And so I think getting Macy's at $4 or $5 is going to be a steal in 5 years. Hey, if that's your approach and that's your method for picking stocks and you've been successful at it, by all means, go for it. I'm a momentum trader. So if the market rolls back over, I think some of these stocks leading to the downside are going to once again lead to the downside. So that's why personally they're not attractive to me. I would rather be in Amazon, for instance, which not only broke out to a 5 or 6 week high yesterday, gaining 5%, but also while the price was going down is showing an accumulation distribution that's going up. So it's telling me that stock's being accumulated. Take a look at Macy's again. Look at Macy's. As Macy's is going down, look at the accumulation distribution going down with it. Completely different picture. Two stocks in the same group that are strong, that the group is strong, but Amazon to me looks very good. Macy's does not. All right. What else do we have going on here? Well, let's go ahead and move on to the earnings spotlight. Not too many companies reporting, like I said, this week. Lindsay's, this is about a $1 billion company, Lindsay Corp. I pulled this one up because as it was going lower, the accumulation distribution was setting new highs. And so if I'm going to look at a stock that's actually been beaten up, I like the companies right now that are showing accumulation distributions on the rise. And the way you see these many times is these hollow candles versus the filled candles. If you got a lot more hollow candles on your chart than filled candles, hollow candles, by the way, means you're closing above your open. Filled candles mean you're closing below your open. But when you've got a lot of hollow candles, even if you're getting gap downs, you can gap lower and then be accumulated during the day and resulting in a hollow candle. That essentially is what leads to these strong accumulation distribution numbers. So to me, it's a combination. I want a strong accumulation distribution, but I also want strong industry groups and strong stocks within those industry groups on a relative basis. If I can put all of that together, I feel much more confident trading my stocks. So Lindsay Corp, which did come out with its earnings, they beat 51 cents versus 49 cents. We'll begin talking more about earnings probably in the next week or two as things begin to pick up. But so far, nice reaction, heading into earnings. Although I will say that this morning, I think the stock is down after its earnings were out. It's down about 2%, 92.50. So if we go back, look at the chart, that's about where it broke out from yesterday. Will it print another hollow candle? Are we going to gap down and then rally? Very possible, looking at what I see here on the chart. So Lindsay's is going to be one, at least maybe to keep an eye on. Shaw Communications reports Thursday after the bell. Got Delta Airlines coming up, some others. So we'll want to keep an eye on some of these earnings reports. But really, the next couple of weeks is when things are going to start to pick up. All right, let's move on to upgrades, downgrades. One stock being upgraded is Constellation Brands. Constellation Brands, you can see a lot of hollow candles here recently, and we are starting to see the accumulation distribution pick up. But it was upgraded today, and let's just see what it's doing pre-market. It is up 4%, so it's up 147.99. So on the chart, it's going to be challenging this overhead resistance. A lot of gap resistance between about 145 and 155. Recent highs right around 150. We're gapping up into that zone today. As a short-term trader, if I was in the stock and I got the upgrade and getting this bounce, this is probably an area I would think about taking some profits. Things are improving, but you can see it's not breaking out to a new high in terms of accumulation distribution. So there are still some issues here. Some other upgrades that are out this morning. We got Lowe's, Mohawk MHK, SBA Communications, SBAC, and Voya, life insurance company, VOYA. Some downgrades today. Chesapeake Energy. I'm going to pull this chart up. Chesapeake Energy, been in this long downtrend. Look at the stock trading at 17 cents. Well, I hadn't looked at this one in a while. Can't believe it's 17 cents. But as it's been going down, you can see accumulation distribution been going down with it. That is, to me, confirmation that a stock is being distributed. When you see the price going down and the accumulation distribution going down, I'm not interested. And that's the way you see many of these energy stocks. So I'd be careful, still be very careful with the group. Other downgrades, CVA, Fastenal, FAST, Granger, GWW, Owens Corning, OC, and Twilio, TWLO. Those were downgraded among many others. All right, let's finish up with the three you must see. And I'll just pull these charts up pretty quickly for you. When I looked at these, one of the winners yesterday when I went through this list was Nordstrom's. Most of these winners have very weak accumulation distributions. This one has also been very weak, but it's getting a nice pop. And accumulation distribution has not been bad in Nordstrom's. So if I look at a Nordstrom's versus say, a Macy's, I actually would like something like Nordstrom's based on this accumulation distribution. Now, it's been a horrible performer. Relative strength is not that good, but at least it has one thing going for it. Next up, Defensive Group. This one did not do very well yesterday, but I actually like the stock. Campbell Soup, accumulation distribution strong. It was at a 52-week high just a couple weeks ago. So the weakness actually likely presents an opportunity. I think Campbell Soup looks pretty good. And then the last one I'm going to bring up is MNTA. A lot of the Earnings Beats members know I've been talking a long time about biotechs. I think the biotech area is strong. This has been one of the stronger stocks. Now, it's not up at a high, but I would not be surprised to see this breakout above 29.30 and a return to the highs. When you look at a relative strength on MNTA, it has been very, very strong relative to the S&P, relative to the biotechs. And biotechs just recently broke out again versus the S&P. So I think you got to look at a stock like Momenta. All right, that's it for today. Again, want to thank you all so much for tuning in. Be back on Thursday. In the meantime, tomorrow, I'll be back at Earnings Beats. Have a great day, everybody. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.